I'm Jason Stipp from Morningstar. This week we're rolling out Morningstar's Guide to Better Investment Picking, and today we're checking in with senior alternatives analyst Josh Charney about better alternatives investment selection. Josh, thanks for joining me.
Thank you, Jason.
Alternatives is a pretty broad category. Lots of different categories or types of funds might be in alternatives. How does Morningstar look at alternatives? How do we break it down?
So we've always defined alternatives across three different buckets. The first is an alternative strategy. The second is an alternative asset class. And the third is an illiquid asset class. So for an alternative strategy, generally a fund would have to have some sort of hedging characteristic to it. So like a long-short equity fund can hedge 20, 50%. For an alternative asset class, generally we're looking at asset classes that are uncorrelated to the market. So for example, commodities used to be alternative. Now we sort of just kind of think of commodities as commodities. But currencies is a good example of an alternative asset class. And then finally, illiquid asset class that isn't really applicable to the 40 Act mutual fund space, but something like private equity or venture capital we define as alternative as well. And so that breaks down into roughly 7 different categories in the open-end alternative universe that Morningstar defines as alternative. And those are bear market, multi-alternative, managed futures, market neutral, multi-currency, long-short equity, and non-traditional bond is generally a hybrid category that has some alternatives and some traditional funds as well.
And we've seen assets flowing into a lot of these different kinds of alternative mutual funds. In fact, there's now over $300 billion of assets in alternatives. What do you think has been the reason that they've seen the growth that they've seen?
I think the reason has kind of evolved and changed over time. Part of the asset spike was following 2008, where investors were, generally worried about getting into the market. So, back then, long-short equity strategies were really popular. These funds had a much lower beta and had hedging characteristics to them. Another strategy that has gained popularity as investors are looking for new sources of return is some option strategies. Bonds haven't really been yielding a whole lot, although treasuries have been declining. People are worried about rising interest rates, and so option strategies are a good place to look for. And finally, I think investors have been fearful that rates are gonna rise. So the non-traditional bond category has gained quite a lot of assets, and some of these funds can actually short duration. So like the PIMCO Unconstrained Bond Fund, for example, can actually go negative 3 years of duration and potentially gain if interest rates go up.
So those funds give the managers a lot of latitude, depending on what the market situation is, to change the character of the portfolio. So if I'm thinking from a portfolio perspective as an individual investor, how I would want to allocate assets to alternatives, how should I go about that as far as the place they would take in my portfolio, and what do I need to be mindful of?
So, this year, Morningstar and Barron's did the 8th annual Morningstar Barron's Alternative Investment Survey. And one of the things we found is that most investors allocated between 6 and 20% to alternatives. And that was a survey done with advisors as well as institutions. One of the things that I think investors need to be mindful of is, don't just invest in alternatives, to lower the fund or lower a portfolio's beta. You can lower a portfolio's beta very simply by just selling some securities and moving into cash. So it really has to have some sort of unique characteristic to it. And generally, when we think about unique characteristics, we think about low correlation. So, a long-short equity fund that has a very high correlation to the S&P 500, can generally be replicated by a combination of S&P 500 and cash. So low correlation is definitely one of the key characteristics to look at.
So when you're looking at correlations to the market, and you were saying don't just consider that, but also how this investment would play with the other kind of investments that you have in your portfolio.
Yeah, so I think that's a really important point to make. So it is true that different alternative funds correlate to different aspects of one's portfolio. And let's say you have 80% of your portfolio in equities, but you're really worried about that 20% fixed income sleeve. So you take some of that 20% and you allocate it to non-traditional bond funds. Well, there are some non-traditional bond funds that correlate very heavily to equities. And you actually did yourself a disservice there. You would be less diversified by doing such a move like that. So it's very important to look at alternatives in the sense where they're interacting with different funds within your portfolio, as well as the correlation amongst the constituents of your portfolio as well. And the last thing you should generally look at is alternatives should improve the risk-adjusted returns of your portfolio. So generally, let's say long-term, maybe the market has a Sharpe ratio of roughly 0.4 or so. You'd want to look for alternatives that have at least that high of a Sharpe ratio, maybe even slightly higher.
And Morningstar covers several alternatives, 70 alternative funds, and some of those have a medalist rating, which we would consider to be forward-looking, likely to outperform their peers. How would you get a medalist rating? How do you, as an analyst team, decide these are funds worthy of investors' attention because they're very good in their categories?
Yeah, so we currently, as you said, we have 70 funds that are rated. We have 21 funds that we currently cover that have that bronze, silver, or gold rating, the rating that we think that means that it'll improve amongst the categories. And that actually comes down to only 4% of the alternative universe. So we're definitely very conservative and very picky for funds that we select. It's the same 5-pillar process as as the rest of fund research at Morningstar. So we're looking at people, we're looking at process, we're looking at parents, we're looking at performance, and we're looking at price. Generally, when we look at people, we try and find managers that have had some alternative experience, so like shorting or hedging characteristics to them. In terms of the performance, one of the things that we look for is performance of the short portfolio as well as performance of the long portfolio. We're looking at alpha as a whole, and are they making good security selection bets? And with price, these funds tend to be more expensive. I would say probably 40 to 50% more expensive than the traditional peers, but we're definitely looking for some of the cheapest constituents. And finally, for parent, we look for fund companies that are very good at constraining some of their alternative launches. There are definitely some fund companies out there that see alternatives as the next big moneymaker, and at Morningstar we're trying to look for those firms that have been in alternatives a long time, have a proven track record in managing alternatives.
Have been thoughtful about their fund launches. Hopefully.
Exactly.
So we know at Morningstar that there can be great funds that can be used poorly by investors because they get in at the wrong time, they get out at the wrong time. So if I'm thinking about getting exposure to alternative funds, what should I know as an investor going in? What kind of mindset should I have so that I can use these investments well?
I think the mindset has to be, you should be comfortable and familiar enough with the strategy that you're going to, sort of ride it out. And what we saw is following 2008, there was a lot of investors that got into managed futures funds because the asset class went up about 8% in 2008 and did very well, and subsequently has had, a couple, really poor performing years. Same thing with a big fund in the long-short equity category. Mainstay Market Field had done really well for many years, and we saw a lot of hot assets move into it. But as performance has kind of subsided, investors have kind of pulled back. So definitely investors haven't been very good at timing these funds, and so I would say that most investors should be comfortable enough with the strategy to understand that they should ride it out through thick and thin.
Josh, very good insights on an asset class that a lot of folks probably are still just learning about. Thanks for joining me today.
Thank you.
From Morningstar, I'm Jason Stipp. Thanks for watching.